Hi everyone, we are Group 15 and we are here to report the statement of cash flow.
Significance of this report is that the statement of cash flow provides a valuable insight into the company's liquidity and ensures the health of cash flows. While the purpose of this report is to give a wider picture to the importance of cash flows in accounting and finance in general. So let us now dive into the statement of cash flows. Imagine a company as a bathtub filled with water. The statement of cash flows tells you where the water or cash is coming from and how it's flowing in and out. Statement of cash flows tracks cash movement. It reveals all the cash coming in and going out during a specific period. It works alongside the balance sheet and income statement, providing a more complete picture of the company's financial health. They also say that cash is king, so a healthy cash flow shows the company can generate enough cash to stay afloat and invest in growth. Overall, the statement of cash flows helps you understand a company's liquidity and its ability to generate cash from its core operations. Cash inflow and outflow are the two sides of the financial coin, representing the lifeblood of any business. In a nutshell, cash inflow is basically the money that comes into the business, like sales of products or services, investment returns like dividends, interest, or profits from selling investments, or financing like loans, issuing stocks, or other ways to raise capital. On the other hand, cash outflow is the money that goes out of the business. For example, operating expenses like rent, salaries, supplies, or anything running the day-to-day, investments, and financing like repaying loans, distributing dividends, or buying back shares. The statement of cash flow activities is like a detailed breakdown of where a company's money is moving around during a specific period. Think of it as sorting your laundry. You separate clothes by type to understand where they came from and where they're going. Let us first start with the operating activities. This is the core business, like cash received from selling products, paying for supplies, and employee salaries. It reveals how well the company generates cash through its regular operations. Second would be investing activities. This involves buying or selling long-term assets like equipment, buildings, or other businesses. It shows how the company invests its surplus cash for future growth. And last one would be financing activities. This deals with raising or paying off debt, issuing or buying back stocks. It indicates how the company manages its capital structure and finances its operations. So here is a sample cash flow information from Teen Wolf Company for 2020. We have here an additional information. The company's statement of financial position reported a cash balance of 500,000 pesos as of January 1, 2020 and 719,000 pesos as of December 31, 2020. For letter A, payments of interest, that is worth 82,000 pesos. This would be classified as an outflow and is part of the operating activities. For proceeds from the sale of land, that is worth 79,000 pesos. This would be classified as an inflow and is part of the investing activities. For cash withdrawal, it would be 121,000, classified as an outflow and is part of the financing activities. For depreciation expense, that is worth 24,000. This would be non-cash. For collections from customers, 183,000. This would be an inflow and is part of the operating activities. For payments of income taxes, that is worth 154,000. This would be classified as an outflow and is also part of the operating activities. For additional cash investments worth 189,000 pesos, this would be inflows and is part of the financing. We also have here the final example of the statement of cash flows for Teen Wolf Company for the year ended December 31st, 2020. So we classified accounts from operating activities, from investing activities, and from cash flows from financing activities. Sum it all up, and we have the cash balance at the end of the period, which is 719,000 pesos.
There are two ways to report a statement of cash flows: the direct and indirect methods. Here, I'll describe the direct method. Direct method for preparing the cash flow statement. So the direct method involves directly tracking and reporting the actual cash inflows and outflows associated with the company's operating activities. It provides a more straightforward view of cash flows, showing the specific sources and using of cash from the core business operations. Steps involved in the direct method. Operating activities. The cash flows from operating activities are determined by recording cash receipts and cash payments related to the company's primary operations. These include cash received from customers, cash paid to suppliers and employees, and also cash paid for operating expenses. Adjustments. So various adjustments are made to convert accrual-based accounting figures to cash-based figures. For example, changes in working capital items like accounts receivable and accounts payable are adjusted to reflect the actual cash inflows and outflows. Calculation. The net cash flow from operating activities is calculated by subtracting total cash payments from total cash receipts. This figure represents the net cash generated or used by the company's core business operations. Investing in financing activities. Cash flows from investing in financing activities are calculated directly, similar to the indirect method. These include cash flows related to investments in assets, example, property, equipment, and financing transactions, example, issuing stock, repurchasing stock, taking out loans. Next is net cash flow. The net cash flow from operating activities is combined with the net cash flows from investing in financing activities to arrive at the overall net increase or decrease in cash for the period. So the direct method provides a more transparent view of company's cash flows as it directly shows the actual cash received and paid for operating activities. However, it can be more complex and time-consuming to prepare because it requires tracking and reporting individual cash transactions. So next is preparing the statement of cash flows using the indirect method. So the statement of cash flows is prepared by following these steps. Step 1. Determine net cash flows from operating activities using the direct method. Operating net cash flow is calculated as follows. Begin with the net income from the income statement. So then add back non-cash expenses such as depreciation, amortization, and depletion. Next, remove the effect of gains and/or losses from disposal of long-term assets, as cash from the disposal of long-term assets is shown under investing cash flows. Next is adjust for changes in current assets and liabilities to remove accruals from operating activities. Step 2. Determine net cash flows from investing activities. Investing net cash flows include cash received and cash paid relating to long-term assets. Step 3. Present net cash flows from financing activities. So financing net cash flow includes cash received and cash paid relating to long-term liabilities and equity. Step 4. Reconcile total net cash flows to change in cash balance during the period. To reconcile beginning and ending cash balances, the net cash flows from the first 3 steps are combined to be total net cash. So the beginning cash balance is presented from the prior year balance sheet. So the total net cash flow added to the beginning cash balance equals the ending cash balance. Step 5. Present non-cash investing and financing transactions. Transactions that do not affect cash but do affect long-term assets or long-term debt and/or equity are disclosed either as annotation at the bottom of the statement of cash flow or in the notes to the financial statements. So how does the indirect method differ from the direct method? So the direct method is a straightforward approach where each cash transaction is recorded in the appropriate section of cash flow statement, while the indirect method is an alternative approach where the information on the income statement and balance sheet plus some supplemental information is used to prepare the cash flow statement. It's worth noting that while the direct method is a more accurate representation of cash flows because it's less commonly used due to its complexity. Many companies also and organizations prefer the indirect method, which starts with net income and adjusts for non-cash items and changes in working capital to arrive at the net cash flow from operating activities. The indirect method is considered more manageable but relies on accrual-based accounting figures.
Analyzing financial ratios derived from the statement of cash flows tells about a company's financial health and its ability to generate cash. These ratios help us understand various aspects of the company's financial performance, liquidity, and overall stability. In this report, the statement of cash flows include four key ratios. The first one is operating cash flow to current maturities ratio. Operating cash flow to current maturities ratio is a ratio that helps us know a company's ability to cover its debt obligations with the cash generated from its core business operations. A higher ratio indicates a stronger financial position as the company has more cash flow than needed to meet its upcoming debt payments. The formula for this ratio is by dividing operating cash flow to current maturities of long-term debt and current notes payable. So what is current maturities? Current maturities is defined as the portion of long-term debt that will come due within the next 12 months. Next, operating cash flow to debt ratio. This ratio provides an info of a company's ability to service its outstanding debt with the cash generated from its core business activities. A higher ratio generally indicates a stronger financial position, as the company has more cash flow readily available to manage its total debt. The formula for this ratio is operating cash flow divided by total debt. Total debt is calculated by adding up company's liabilities, which are categorized as short and long-term debt. Next is operating cash flow per share ratio. It is a ratio that measures the cash generated from a company's core operations on a per share basis. It's a key indicator of a company's ability to generate cash flow for its shareholders, and a higher ratio generally signals stronger financial health and a better potential for future growth and dividend payments. The formula for this ratio is operating cash flow minus preferred dividends divided by weighted average number of shares outstanding. Preferred dividends are the part of a company's earnings that are paid to preferred stock or shareholders. These are prioritized over ordinary shareholders, while shares outstanding are all the shares issued and sold by a company that are not held by the company itself. Lastly will be dividend coverage ratio. Dividend coverage ratio quantifies a company's ability to financially sustain its dividend payouts. It measures the number of times a company's operating cash flow can cover its annual dividend payments. The formula for this ratio is operating cash flow divided by cash dividends. So what is dividend? Dividend is a distribution of profits by a corporation to its shareholders. Dividends can be issued in various forms, such as cash payment, stocks, or any other form.
So here are the procedures for development of the statement of cash flows. Cash inflows and outflows are determined by analyzing all balance sheet accounts other than the cash and cash equivalent accounts. The following account balance changes indicate cash inflows and outflows. For cash inflows, when there is a decrease in assets, there is an increase in assets and cash outflows. When there is an increase in liabilities and cash inflows, there is a decrease in liabilities in cash outflows. And when there is an increase in stockholders' equity for cash inflows, then there is a decrease in stockholders' equity for cash outflows. Next part would be the techniques in preparing the statement of cash flows. So for the first step, there are first three techniques may be used to prepare the statement of cash flows. Number one is the visual method. Number two is the T account method. And number three is the worksheet method. Second, the visual method can be used only when the financial accounting information is not complicated and not on preparing financial statements. Third, When the financial information is complicated, either the T account method or the worksheet method must be used.
Next, steps in developing the statement of cash flows. Step 1. Compute the change in cash and cash equivalents. Step 2. Compute the net change in each balance sheet account other than the cash account. Last, step 3. Consider the changes in the balance sheet accounts along with the income statement for the current period and the supplementary information. After analyzing the statement of cash flows, we conclude that it is a vital tool for understanding how money flows in and out of a business. Activities in the statement are categorized into operating, investing, and financing activities. The operating activities section can be presented by using the direct method and indirect method. The financial ratios from the statement of cash flow contributes a comprehensive understanding of a company's liquidity, debt management, investment decisions, and dividend sustainability. Overall, the statement of cash flow is crucial for effective financial analysis and decision making, providing a clear picture of a company's cash flow. Thank you all for your time and attention. We hope that our report about the statement of cash flows has provided valuable insights. Again, thank you for listening.